One of the major focus for Astor is for sure making sure that our investors have the best investments, the best projects, making sure that we're maximizing their returns and making sure that we're protecting their hard-earned cash. And one of the most important things for us as well is not only is making sure that your hard work money is downside protected, but there's also a very big tax implications that come along with all different asset types. So today we are taking you behind closed doors with one of our trusted tax advisors here at Astor. And I'm happy to welcome Adam. We're gonna dive deep into how he does what he does and the expertise, and we'll take some questions as well. So welcome, Adam. Thank you. It's
Yeah.
a privilege.
Thanks for having me. Appreciate it.
So let's just get started first from the beginning. Who is your client? What are your clients? And what are the high level areas that you really provide service for?
Sure. I mean, my typical client is somebody that has a tax pain point that's typically at least 100,000 or greater, right? It could be much more. I have clients that have millions of dollars in tax, concerns and looking for planning to help mitigate those tax liabilities that they have, either on an annual basis or it could be even just a transactional sale. Some clients are selling multi-million-dollar businesses. I have contracts for a company that might sell as early as 2025 that will be $3 to $4 billion. So it's everybody from maybe that $1 million starting point, $100,000 of tax liability, or all the way up until the billion dollar type client.
Yeah, those are really important things for us to look at because not only do we make sure that we do that for our investors, it's our own capital that goes into all the projects that we look at as well. So let's use an example, right? So one of our projects that we have, what would be the best way to start with example of one of the projects where we can.
So, first of all, I mean, I love the creativity, and we deploy a lot of creativity in choosing the assets that we choose, and where we look for areas where our investors can gain the highest possible returns on mitigating as much as we can on the risk. But there's just so much out there. So we deploy alongside with you, we deployed all sort of strategies. So, for example, when we're going after condo projects, right, we're building a beautiful building. Condos tends to generate the highest returns. At the same time, the tax impact is also the greatest, right? So, just taking all those things into account, making sure that our investors not only make the highest amounts, but also retains as much of it as possible. And this is why Adam is like so important. So Adam, we deploy different strategies, right? In our operations, we have three major strategies. Strategy number one is we enter into a project as investors, right? We'll build a great building, we'll stabilize it and sell it, right? After a short period of time. Other strategies will come in as preferred equity, kind of like different positions. Other times will come in just as debt structures and debt platforms. When we're looking at a project, what are the most important things as from the eyes of the investor in order to obviously choosing the project is our business, making sure the execution goes flawlessly is our business. But then once we yield the type of returns, what sort of thinking goes into it when it's your side of the equation?
Well, I wear multiple hats, right? So when I'm referring clients to you to invest, it's about your capabilities with risk control and the due diligence that you do is far superior than many other folks that do what you do.
Thank you for saying that.
So that makes me feel very secure. But it's a blessing and a curse when you perform like you do, right? You have great returns, but then wait a minute, how much do I have to give away to the government? So that's where I come into play. And that's where my tax planning company is really what I lead with, right? I can better serve every client by giving them tax strategies. Because at the end of the day, it's not necessarily how much you make, it's how much you keep.
Oh yeah.
Like you said.
Oh yeah. Oh yeah.
And that's exactly what I do.
Oh yeah.
So the exit strategy for any one of those three structures that you have, it's important. Right? If you get a 15, 20, 30% return, keeping 100% of that is doable all day long.
Yeah, it's a night and day. I mean, we're in our side of the equation. I mean, we do a lot of with a lot of IRA money, specifically when it goes to certain type of product. We literally turn away investors with the simple explanation. Look, I mean, if we're building a condo, if we're able to generate, some of our last couple of projects on the condo space, it was 26% annual return. And people have made double and over. And I'm not trying to toot my own horn. This is kind of it's a higher risk and obviously a higher yield. But then I turn people away and I say, listen, if I'm generating for you such a high return, and the income tax that you're going to have to pay, the returns, because ordinary income is so great, I much rather put you in a lower risk and get you a 14, 15% return. Without giving you that type of an impact.
Right.
But with you, we found different structures. So I wanted to maybe speak about some of those. What sort of tools, without going in too much or too heavy into it, just for our investors and viewers to understand, what sort of tools are out there that you can use in order to minimize tax impact?
So, I mean, really, there's proactive tax planning. So I try to break things. It's complicated, right?
Yeah.
But I try to
Sure is.
make it
Sure
simple
is.
for people
Sometimes
to
my
understand.
eyes glaze over when you start.
It's one of the
going
most
into it,
complicated things.
But I know I gotta keep it.
So, proactive planning, right? You put structures in place prior to the taxable event, or there's reactive planning, which is that taxable year, and when you might have had a capital gain, or maybe you have income tax concerns. So, in combining the two, and every scenario is different. Every single client's different. They have different financial structures. Their family dynamic is different. Everything's different. But the core, I prefer to start with proactive planning, utilizing different types of trusts. So in doing so, we can really handle the three largest taxes that anybody's going to experience in their life: capital gains, income tax, and estate tax. So estate tax, we can eliminate 40% estate tax with trusts and doing it the right way. We can eliminate that. Passes for generation after generation.
That's huge. People don't like to talk about it because that's kind of like the later part of life, and
Right.
But it's kind of like important planning. But you've said capital gains, right? So when we invest together and we create money for you, right? We sell the asset. We all have our capital gains, whether it is long term, short term, right? So that's important. That's obviously right dead in the center of where we want to focus on. Estate tax, which is the later part, in life,
and then the middle end. So
and then the income tax.
right. So it's not always the investments.
Right.
But it could be high income earners. So doctors, I have a ton of dentists that do business with me. They're all selling their dental practices. So we help them defer on that business sale. And then what do they do with the money? They say, okay, I just liquidated my dental practice. I have 3-4 million. I need to reallocate that to produce a return, and then obviously create different revenue because they've sold their practice. So the high income earners, there's ways with different trust structures. A core trust that it has a beneficial interest is basically the core qualifying for tax deferral treatment. Then there is business trusts that we can pair for active income. So this is any type of business. Doesn't have to be a medical professional.
So you're saying, let me just make sure that we all understand this. And I'm kind of like, I know that the structure of a trust, essentially, you create a vehicle, right? You create a legal entity outside of me as a person, right? We're married. So outside of us, right? There's a legal entity. And then what happens next? We operate like every investment is done through it. Is that what's the mechanism of it?
Right. So the goal is to own nothing but control everything. Right. That's the Rockefeller principle.
Love it. Own nothing but control
That's
everything.
the Rockefeller principle.
Yeah.
It's been around for almost
I
200
like to
years.
control everything better than to own nothing, but
Correct.
I guess it goes hand in hand. If you own nothing, you owe nothing also on taxes, right?
Potentially, right?
Potentially.
We can mitigate And sometimes we can get zero tax results, but sometimes
Yeah.
there might be some tax, right? It depends.
Right.
The beauty of the structuring is you can be as aggressive or as conservative in the approach as you want. So if you decide to pay a certain amount of tax, take taxable distributions out of the trust, you can pay tax.
Right.
There's best practices that our team of folks can teach you, right, to minimize it.
So it's mitigation of tax,
Yeah,
right?
absolutely.
So when I own nothing, who owns everything that I own?
The trust would own it.
So the trust would own it.
So now you're taking
So I roll it into-
assets out of your estate, out
Okay.
of your taxable estate,
Okay.
right? It's called corpus. Now it's a trust corpus asset. And if, in essence, right, if you have a business or a piece of real estate or you have after-tax investments, so even clients that are currently invested in your deals,
Right.
they can set a trust up and we can literally retitle your investment into the name of the trust at basis, what they paid for it. That's not a taxable event at that point.
Okay.
Okay? Now it is a corpus asset. So when the exit happens or when your dividends or whatnot flow in, dividends are passive income, completely tax deferred. But when the sale event happens, that bigger upside, that's when you're producing those
Capital events.
capital events, 20%, 30%, whatever it is.
Right.
Now, all those proceeds land in the trust as corpus.
I see.
It's not taxable because the vehicle itself qualifies for tax deferral treatment.
I see. Interesting.
What is the timeline that actually goes into creating the trust? And anyone that doesn't have it yet, what is the actual timeline? What is the procedure you talked about? The proactive planning, and then there's also the reactive planning.
Right.
So can you go through a little bit in detail of those and the timeline?
As far as the timeline to set up a trust,
Yes.
Typically once a client is educated, features, benefits, outcomes, they understand the history, they understand a little bit of the legal elements. Once they engage my firm, it's anywhere from 2 to 3 weeks, maybe a month at most, to put the trust structures in place. And that's the proactive planning. And then that deals with all the asset conveyance, right? Moving assets from other entities or personal name into the trust. Now you have absolute asset protection. You have your control elements there, which is the number one benefit of every one of my clients is the control aspects, is what they want most. You have your tax benefits, your estate planning benefits. There's also legacy and wealth transfer. So it's very powerful. And there's flexibility built within the trust documents because at the end of the day, for people that don't understand what a trust is, it's a contract, right? And the U.S. Constitution says, common law says that U.S. citizens have the right to have contracts amongst themselves. That cannot be taken away unless they change the Constitution. Very powerful. Trust law actually, common law, trust law predates fiduciary law, which is what really governs the court systems in our country. So this is deep-seated history that we're tapping into to plan and help clients and really empower clients to control more of their hard-earned income. And the thing that I like most about my career and what I do is I see greater good happening all the time. Instead of giving hundreds, millions of dollars away to the government, they're reinvesting it into projects. They're uplifting their communities. They're doing charitable works throughout the world.
Yeah.
We were at a conference just the other month, and we literally ran into people that are running worldwide charities doing amazing things because they're being intelligent with their tax techniques, right? They have more money to give for greater good, which is amazing.
Pretty fascinating. I wonder, how come no one, I shouldn't say no one, people in the upper echelon are certainly using these strategies and other strategies as well, but for the local guy, for the local family who's looking to invest and grow their wealth, how widely available this thing is?
Well, this type of planning is very niche. So the billionaires, the biggest names in America, biggest family names, the Rockefellers, they've been using this for decades, right? The entire trust industry has actually kind of been turned on its head recently. So this current administration is looking to collect money.
Right.
They're starving for money because we have trillions of dollars of debt. So they did away with conservation easements. They're trying to, or they did that. That was the number one thing they did this year. And now they're trying to target trusts. And the thing that is happening in my industry, I've been in this over a decade, is there's a lot of fast-moving folks that are just trying to sell trusts. They might market, they might say similar things, they might say you're going to get the benefits, but the reality is it's all about the contract. Just like an insurance contract is different, every single insurance policy is a contract. Same thing with a trust. You have to have the right contract, right? That is valid, that is actually compliant,
Sure.
and actually achieves the benefits that people are presenting.
And this is why we work together because, it's, they say it's an 80-20 type of a scenario. Eventually you want to work with the best that you can. Not everyone is equal here. This is it's not a commodity. It's a highly specialized service. I know we've spoken to a lot of professionals. We met a lot of professionals. We shook hands with a lot of professionals, and yet we chose yourself, and we're talking to one other individual on the West Coast. We may work with them. We may not. Because at the end of the day, it's the knowledge. It's the ability to, obviously, the service that you bring is, I think, top notch. I want to compliment you on it. It's your availability, and really, the end result is, folks are just, the bottom line. And it makes a big dent and makes a big difference in the
Not
bottom
all
line.
trusts are created equal.
Oh, yeah. Oh, yeah.
It's incredibly important, the details that go into the contract. A small little thing, like the jurisdiction of a trust,
Right.
makes all the world of a difference, right? The taxing authority can be affected by that. If you put IRS code or whatnot in the trust document, the IRS is #1 taxing authority. If you put these United States, it's completely different. U.S. Treasury, then it's the Uniform Principal Income Act, and then it's the IRS. And all these little details make a huge difference
nuances.
in even what accounting is considered.
That is in the details.
Yeah. So instead of gap accounting, right? When you just have a simple component in the trust, now it is fiduciary trust accounting, and that makes a world of difference.
I see.
So all these little details are very important, but at the end of the day, it becomes, I think, and I think anybody that's listening to this, if you're going to step into this world of advanced tax planning, #1 thing is risk control. If you don't have risk control, you don't have the proper professionals that are credentialed, CPAs, attorneys, right? Tax attorneys, litigators, that whole team that Tax Deferral Services, has, right? That I would advise not to do it. Simply don't do it.
Right.
Because if you don't have the right risk control, the same thing with you. I said at the beginning that this entire call, as an advisor referring people to multiple investment sources, I pick you as one of my core alternatives because you have superior risk control. Same thing with what I do.
So there's a lot of information out there, right? Like just like people have the ability to choose between different advisors working with Astor, they can choose who they're going to invest with and how they do it. And people that come to us specifically want to work with us because of those different things as well, the risk control and who we are and how we operate. So Adam, there's a lot of information out there, especially also, with the social media and things that people put up there.
Yep.
Who knows what to believe and what to listen to. So I want to make sure everything that we just touched on and talked about, what are some of the very important things to make sure to look out for and watch out for, or specific information that you do see out there that you might want to advise people that doesn't really align
Right.
with what you would advise?
Yeah, it's an interesting time in the trust industry. The DOJ literally just indicted and arrested a Denver person and a Texas person. They were doing trust structure since, I think, 2017. I read the indictment. And when I read it, I'm like, I can't believe that they've been doing this long. They just had a bunch of business trust, and it was just passed through. The entire structure was garbage, but they were selling it for years. So those type of bad operators out there, you need to watch out for that and get third-party advice. So before my clients even do business with me, I make sure they do their own due diligence. I provide a lot of great information, but at the end of the day, I help either give them access to professionals that can give them that third-party advice, I encourage getting letters of opinion, right? So a legal letter of opinion will prevent the IRS from charging a tax penalty. That's pretty important, right? Having CPAs that understand the trust structure and they're going to do the accounting properly, making sure that there's a specific disclosure form that you can file with a trust tax return, a 1041 tax return, and that disclosure form that's filed every single year is even more powerful than a legal letter of opinion in the sense that if the IRS doesn't respond to it, you're literally saying, this is the tax treatment. This is the tax authority. Here it is on the table. Nothing's hidden. If the IRS doesn't respond, they cannot charge a tax penalty or interest. Legal letter of opinion is just tax penalty. So all of these little factors about risk control is super important. And then you look at what's happening in the industry, and I know who all these people are, right? I've been in this so long. I know who the players are. I know who does it almost correct. I know who does it completely bait and switch incorrect. And a lot of the social media, and this is probably what has brought a lot of attention into the trust industry, is it's TikTok and YouTube and Instagram, right? And they're great at marketing on these platforms.
Oh, so when you see like a 26-year-old that talks to you about trust and started like 6 months ago in TikTok, you mean you should stay away from that?
I mean, that's a red flag.
Okay, all
Most
right.
of them are the bad
Just
operators.
making sure.
Right. Not all. I can't say it's
Yeah,
across
of
the
course.
board.
But
but-
nothing against you. If you're a 26-year-old and you're in the world of trust, and it's not aimed against you. I'm just thinking about one or two specific individuals. But yeah, I think it's a very, very, very delicate subject.
It is.
And so we certainly don't want to paint everybody with a broad brush. But it's quite fascinating. Other than trust, what other type of tricks do you have in your bags that we
Yes.
can offer our investors?
Right. So the core trust that actually has the tax benefits, that's the core.
Yeah.
We can add on business trusts, which deals with income tax mitigation. And then we can do a charitable trust,
Okay.
which actually, the type that I like, the client still remains in control. So it's actually a family foundation charitable trust, 501c3.
Okay.
And that allows you not only to do your charitable pursuits, but then the taxable expenses within the trust for the beneficiaries, food, fun, fashion,
To be
right?
deducted.
Right? You can run those through the charitable trust.
I see.
So it just depends on all the benefits that you want. You can do the 3 trust structure as the proactive planning, or maybe you just do the beneficial trust that we call most of the time we just call a personal trust. Now, when you look at the reactive planning, that's for when you have, in my arsenal, I would say there's 5 or 6 core strategies that have all been tested by attorneys. They're run by attorneys. They have legal opinions. They've passed audits. I don't issue anything that doesn't pass those type of tests.
Right.
So, for instance, let's just say you have $1 million tax liability. And for some reason, you're not interested in the trusts. That's fine. We have ways to offset that $1 million 5 or 6 different ways. And most of them do have a slight investment return potential. So whether you still are a high income earner and have a lot of W-2 income, like medical professionals, right? They might have $300,000, $400,000, $500,000, maybe $1 million if they're a surgeon or something, but it's W-2 goes right to the personal return. Our trust cannot mitigate that, but the other solutions can. So when you pair proactive and reactive planning solutions together, it's the perfect way to approach almost any concern.
And each one of those is its own sort of like structure.
Absolutely.
It's all bespoke. It's all custom made based on the situation.
Absolutely. And it's nice because we can give clients options.
Yeah.
So there's always that the option of how aggressive do you want to be with your trust structures? How aggressive do you want to be with the other strategies? Right? And it's nice because you're not just selling one thing and saying this is the only way to do it, because there's 100 different ways to structure things.
Tell me about drawbacks. Assuming we pick the right party to generate for us whatever structures is right for our situation, what are the drawbacks? Assuming everything was done properly and everything that you've mentioned, and it was the right documents and it was the right language in each and every one of those contracts, what drawbacks we have?
Well, and this is just being transparent, because this is the truth.
Yeah.
The IRS can change the rules or their opinion or their tax position anytime,
Right. But
anytime they want.
the IRS can change the rules anytime. They can change the rules anytime on anything.
Correct.
So we're
So you need
so
to
in
be
other
able to
words-
stay ahead of that.
okay.
Have
So
the right professionals, and then steer away from anything that might have any IRS attention to it.
Right.
There is a type of trust out there that a memorandum was just filed 60 to 70 days ago,
Okay.
and it turned the trust industry on its head, right? But the trusts that I offer are materially different,
Okay.
similar benefits, but they're not associated with a lot of the bad actors that were using a trust name, but they weren't producing contracts that were valid. They might be 20%, 10%, maybe 50% correct,
so without
but it's
going
not
into
100% correct.
without going into too much details, I mean, what was the change that what was the change in
It was
code?
literally after 5 decades of allowing these type of trusts to claim tax deferral treatment, they literally just changed their opinion. And they put a recommendation memorandum that said, we're recommending that you now pay tax. So could you fight that?
Is it retroactive? Is it going
Always
forward?
going forward.
Okay.
It's illegal to go retroactive.
Okay, so that's
right?
okay.
Otherwise, they could dig in people's pockets
Oh,
going
yeah.
years back, and
Sure.
that doesn't work.
Right.
But that change.
Well, I mean, when they do an audit, and if they find that you have mistakes, then they could, right? I mean, there is obviously a statute of limitation, but you're saying that it was not retroactive. It was going forward. We recommend that you start paying your taxes.
Correct.
That's not a fun letter to have. I mean, again, I'm not against paying taxes. I always tell my investors, if you're paying taxes, that means you're doing good. It means we're making money for you.
Right.
Right. That's important to understand. The fact that we want to be intelligent about it, the fact that we want to make sure that you're not paying more than you should, and you stay within the guidelines of what you have to pay, doesn't make you a bad person, right? Okay. Well,
This is kind of what I say about that. It's not illegal or unconstitutional
Sure.
or even unpatriotic to plan to mitigate tax. It's not.
absolutely, it's not.
Right? To be a tax evader is illegal. To be a tax avoider
Yeah.
and to have smart people that are planning to the letter of the law is completely legal.
Right.
And that's what I help people do.
Yeah.
I help people stay away from strategies that I know are suspect. I help people move away from trusts that have the target on their back of the IRS. And there's a big shakeup going on right now, and that's a big part of what I've been doing is helping people move from trusts that might not work into trusts that will work.
There's also a lot of areas where most people don't know all the different strategies that are out there. They're just used to a specific thing, and they're going to continue to even evaluate how they invest or what they invest into just because of the limited amount of tax structures that they know and have. So I wanted to also touch on what are some of the ways that you help operators such as Astor, including investors, to really approach that strategy, to be able to understand that there's different ways and much more unique ways to be able to actually look at investing and be able to do it confidently with the different structures that you know of.
Right. So when you have high returns, a lot of investors will want to do a self-directed IRA, right? With our trust, we don't put qualified money in there. It's standalone because it's a different set of tax laws, right? But for the investor that has just after-tax money, right? They might have a liquidity event. They just sold a business. They just sold a $5 million office building, right? Now they have liquidity. They want to start allocating things.
Right.
So if they invest as the trust, they don't have to worry about that capital gain. The trust is investing into the investment. So that just frees up that tax pain point, and it gives the client a lot more freedom to choose whatever investment they want.
Of course.
And then same thing with any investment of any provider, when they put planning in place, they can either do it in the trust, either before they make the investment or even after, right? Because remember, we can transfer anybody that has money in your deals can actually transfer money in at basis, which is not a taxable event, and that exit is tax deferred. Or
Why do we call it deferred? I'm sorry to again.
eventually-
deferred to when?
it's deferred until they take a distribution out of the trust.
I see. Okay, fine.
So this is something that's interesting.
So as long as the trust keeps on investing its own money,
Yeah,
keeps on investing its own capital. So,
it's a concept of corpus, Joe.
right,
If it's corpus, it remains in the bubble,
Right.
in the trust,
okay,
tax deferred.
okay,
If that money leaves, whoever receives the money pays the tax.
okay. So let's play with this idea. Investor A just came into a large sum of money, sold an asset, sold a clinic, sold a dentist clinic, or a number of dentist clinic, made a $5 million gain.
Right.
Option one, pay the tax. Option two, create a trust. The asset rolls into this trust. Now the asset is actually, the clinics are now owned by the trust, no longer by the dentist. It's owned by the trust.
Yep. Slightly more complicated than that, but
Slightly
yes.
more. I'll simplify it as much as I can. So I want people, to be focused on what we're at. And it could be a business, and it could be your house, and it could be, your last investments at, Astor or somebody else. Makes no difference. You rolled it into the trust, created a trust. Now the trust owns this investment, whatever it is.
Right.
An exit was made. $5 million in this example was created. There's obviously a big taxable event. It's a big tax impact. Could be that, $2 million in tax impact is out there, is now due. However, because it's in a trust, the trust will not be paying it. You'll roll the entire $5 million into an investment, okay? Doing something else with it. That $5 million starts rolling, starts growing, right? Money starts being made on top of it, right? This thing grows. The trust starts growing and mushrooming. When do I get to see it? Is there any way for me to tap into this money and still not pay taxes?
Well, I mean, you're in control, right? The client's still in control, and there's different elements that we do to give them control. But they're making all the distribution decisions and all the investment decisions.
You said dividends. If the trust pays me, who am I in this relationship between myself and the trust? Who am I?
You'll end up being the beneficiary,
I'm the beneficiary.
and then there's a third party trustee,
Manager, yeah.
right? Manager, and we use a
Who gets the distribution? The manager?
trust. The trust does. But now remember, you're the beneficiary of the trust, so most of your lifestyle expenses can be paid out of the trust,
Okay.
right? So
So
everything,
explain to me how does that
everything
work?
except for
So I want to drive my X7,
Yeah.
and that costs money. I want to pay my mortgage, that costs money. I want to take my wife and children out to vacation, everything costs money. So how do I get to enjoy the benefits of the trust while I'm still around?
So as a beneficiary, right? So you guys are beneficiaries, children beneficiaries.
Yeah.
Anybody that's a beneficiary can benefit from the corpus of the trust. So that's anything that besides food, fun, fashion, right, would be non-taxable trust expenses. There are a few line items, right, with trust accounting that would be considered taxable. But then if that's a large amount that you're spending every year, then we would talk about setting up the charitable trust, where then you could cover those expenses in the
So I can use some of this money from the trust, some of the gains, my $5 million sale stays intact. I did not pay my $2 million tax. I now have $5 million that I can reinvest and do other things
You're
with
buying
it.
your vehicles.
Keep on growing.
You're,
However,
Yep.
the trust will buy my vehicle.
yes.
So in other words, I'm not driving my own car. I'm driving the trust car.
Yep.
The trust buys me a house,
Correct. Second house.
second house, third house, whatever it is.
Whatever it is.
Right?
Yes.
It's not my house. If somebody sues me, right, trip and fall in my house or in my yard, right,
Or an income property.
or an income property, whatever I do, it's owned by the trust. I'm the beneficiary. There's a manager, I'm the beneficiary.
Right.
Okay.
And that means that if remember, if you don't own anything, but you control everything, if somebody sues Joe, there's nothing to get.
That's right.
I don't own anything.
That's right.
I have $50 in a personal bank account. You can have the $50.
As you are discussing that, and I apologize to interrupt, we do have a question from the audience about the audit risk. As you are implementing these strategies, talk to us about audits. How do you handle audits and the costs
So yeah, that's what risk mitigation is all about. Audit risk. So when you have the right contract, you're lowering audit risk. When you have letters of opinion, you're lowering audit risk. When you're filing that disclosure form every single year, you're lowering your audit risk because you're going to know right away if the IRS doesn't agree with the tax treatment that you're claiming. The particular trust product line that I'm offering, they were just audited, and we have a copy of a redacted audit. They sold a large piece of real estate in it. They had a bunch of investments that were claiming capital gains, tax deferral. They were living their lifestyle expenses. It's a very typical, I would say, a typical trust scenario, and it passed with a no change result. So this type of information is how we help educate clients about what is the audit risk.
The question I think was how likely it is to get an audit if you do a trust. Is this like a super high likelihood? I mean, if you'll have to put a number or bracket on it, what are we looking at?
So for 5 decades, the trust that I was talking about that the IRS changed their opinion on, just their legal position, for 5 decades, tax returns were filed and not a single audit occurred.
50 years. Nobody gets audited.
50 years on that other one.
Okay.
The one that I'm using, right, over the last 3 years of filing that disclosure form, there's not been a single audit. That audit occurred because they did something funny with their personal return that created a red flag. Once the personal return was flagged in audit, they found out they had a trust.
Are we talking about somebody specific? Who are you talking about?
This was a client of the trust products, right, that I'm offering now.
Okay.
So it's a scenario within the last year that occurred.
So in other words, is it extremely rare to get audited?
It has been.
It has been extremely rare.
But I'm telling everybody that's listening,
Yeah.
times have changed. Trusts are a major focus of the IRS.
I see.
So if you do this type of planning, the reason why I said the most important part is making sure you have all those risk control elements in place. You have credentialed folks helping you. They're licensed, they're credentials. You look at the background on the people that are actually helping you do these structures, because if you have a bad trust, the likelihood in 2024 that they're going to just start randomly, anybody that files a 1041 return, they might randomly audit. But if you have the right documents and they have already audited that particular contract before, the audit goes away very quickly.
Okay.
But if you have a bad trust, now
If
you're
you have a
looking
bad
at,
trust, if you have a bad trust, you have a bad trust.
yes.
If you have a bad-
How can people, for example, that already do have trusts, can they come to you and you evaluate, okay, this is what I think about your trust and this is what I advise? How can they approach that?
It's actually a great question because that's a huge part of the industry now that I'm trying to rescue and help people. So there's a process called decanting, right, where you can decant one irrevocable trust into another, and I can do an analysis. First of all, I can just ask who sold you the trust. I can look at what type it is, and very quickly I'll know if it's one of the bad operators out there that I know of. There's 7-8 versions of trusts I've seen that just don't work. So because I've been in the industry over a decade now, it's pretty easy for me to spot the ones that are suspect. Then that is audit risk. So we can help people take that bullseye off of them, and you do not want to play the audit lottery. You don't. So moving people from that, we ran into somebody recently in one of our conferences. I found out what trust that gentleman had, and I'm like, this is where you're at. You have all these risks, but we can fix it. This is the way we fix it.
Good.
Right?
Very good. So those of you out there, and we have a number of our investors that have used trust, are using trust, are considering using trust. I think the major message here is this is an amazing vehicle, but it has to be done right. The IRS obviously is out there to make sure that things are in line.
Right.
The administration, not just this administration, where the tax authority's job is to levy and collect the taxes. That's what they're there for. If you play around with your taxes, you play around with your taxes. You take in, it's like I tell my son, it's like, running a red light. You can do it 20 times and never get hit, God forbid. Just don't do it. You're creating a high risk. I think it's fascinating that this type of a program is out there. I know that a lot of you will benefit from knowing Adam. We highly recommend Adam, and not only is he's great in what he does, he also offers a great service. Takes his time. He's very, very patient, very kind. He's very pleasant to work with. Anything else before we sum up?
Yes. So I want to talk about how can an investor use pre-tax funds to allocate into real estate investments?
Right. So that's just kind of the beauty of growing the corpus of a trust.
Yeah.
It's you sell a business, you sell appreciated assets, it's corpus, and then you reallocate again, and then you reallocate again, and it keeps getting larger and larger and larger. It's like a giant IRA, right?
We can borrow against it. A beneficiary can borrow against
You
it.
can borrow against it. The trust can get loans, right? You just qualify
You
for.
become your own bank eventually.
You can.
The trust can lend me money
Yep.
at a certain interest rate that in other words, that the trust wishes, which I control.
It's a debt asset. That's all it is. It's a debt asset for the corpus, right?
Right.
Now,
And the
interest typically.
the interest that I pay becomes a deduction for me on the other side of life, right? On my
Right.
W-2 or whatever side of life I have.
Yep.
So it's kind
A
of like
lot of people stay away from debt assets and interest income.
Right.
Because interest income is at ordinary income rates,
Right.
not capital gains,
Right.
like other investments.
not at the trust
Not
level.
at the trust level.
Right.
So there's a lot of uniqueness about wealth building inside of a trust. Why is the Rockefeller family so wealthy? They've been doing this time and time again. I just offer the most modern version of what they've been doing. And what they do is they have this type of trust, common law, right? And they have cash value life insurance. So all the principles around be your own bank with cash value life insurance, those two structures together, having a trust own a policy, that's just smart planning.
Yeah.
And it's not like I reinvented the wheel. I'm just bringing the most modern version out to people that is in front of any IRS scrutiny.
Yeah.
And then I talked to arguably the top attorneys in the U.S. There's a gentleman named Tom Cullinan who was the second in charge of the IRS. He's now working out of the Atlanta office with one of the biggest tax litigating
That's
law
a good
firms
guy
out
to
there.
have, that's for sure.
And he's the one that taught me how the IRS works. He's the one that gave me advice about what to do with the memorandum and how to protect clients. So that level of expertise, his partner's a former DOJ guy, those type of attorneys are who we have direct access to help our clients. And if you have that type of resource, now the question that they had about audit potential and audit risk, well, we have those type of resources to defend any type of audit that would come in.
Right.